Well, Netflix dropped their most recent quarterly report yesterday afternoon, Thursday. And as you can see, there are some folks out there that are none too happy with the results. But were they really all that bad to warrant this today? I don't know. I don't get into hardcore financial data on this channel. That's not what we do here. We never give out financial advice and things like that. But we do like to talk about certain companies that relate to the Hollywood and entertainment industries that we like to cover. Things like film and television production, companies like Netflix, Disney, and HBO Max, and what's coming out and how the box office is doing. Well, we've always have to look at things like this a few times a year as these quarterly reports come out to gauge, well, how well are these streaming services doing? Well, Netflix, by this, you would think that it was terrible news yesterday. But as a matter of fact, it really wasn't all that bad. Let's talk about it. Here we go. Renegade Online. Well, welcome back. Another great day here at Valiant Renegade. Good to see everybody out there. This is going to be a little bit different of a video than probably what some of the newer subscribers I have are accustomed to seeing. And of course, we only really kind of tackle this information about 4 times a year when, well, quarterly reports come out on certain specific entertainment companies, people like Netflix, Disney, HBO Max, some of the ones I mentioned in the intro to this video. And we talk about what's going on with them as it relates to the Hollywood and entertainment industry that we like to cover on this channel. So let's go into this. So as you can see here, here's Netflix today. Nothing really great going on here, but is it really worthy of what is happening? Is it really all this bad? Is it doom and gloom for Netflix? I don't think so. And we're going to talk about why. I want to talk about some of the specific things that Netflix released in their quarterly report because I think it's important to understand context as always. I have been lamenting for some time the hyperbolic focus that some people out there seem to have on nothing more than subscriber growth. I mean, subscriber growth on these streaming services is great, but it's not the end-all, be-all. As you can see here, what I have up, on November 17th of last year, Netflix was around its peak. It was a little over 700 in midday trading, and now it's down under 400 today, having lost at one point today almost $130 a share. But, when you look at the numbers, and this is all reactive to yesterday's report, I want to go into some additional details. But before we get into that, I want to thank everybody for coming back to watch this video. Welcome all the new viewers to this channel, the new subscribers. If you're like one of the 60 or 70% that are not yet subscribed to this channel on Valiant Renegade, please hit that like button, hit that subscribe button, hit that notification bell, share this sucker out on the social medias, and do leave a comment before you head out today. So let's get into some of the nitty-gritty on this, shall we? So here we are. On the public side of Netflix, the investor relations page for the company itself, where they disclose all of this financial data and give us a lot more details than what people just see in headlines, because I think it's important to understand a few things about the success of Netflix, especially after they had such a great year with some of the shows that we've talked about here on this channel, like Cobra Kai and Squid Game, some of the bigger movies that they've produced with big stars like Gal Gadot and The Rock, movies that I've actually enjoyed on Netflix, and I hope they keep making some of these. I think they're a lot of fun, and they're good popcorn movies that people seem to enjoy. But let's talk about what this means in terms of revenue for Netflix and where they are. So this is Netflix's letter to investors dated yesterday, January 20th. Fellow shareholders, we've achieved several milestones in 2021. We've had the biggest TV show of the year, Squid Game, our 2 biggest film releases of all time, Red Notice and Don't Look Up, and Netflix was the most Emmy-winning and most nominated television network and the most Oscar-winning and nominated movie studio of 2021. That's a big to-do for Netflix. Full-year revenue of $30 billion grew 19% year over year, while operating income of $6.2 billion rose 35% year over year. We finished quarter 4 with 222 million paid memberships or subscribers, with 8.3 million paid net adds in quarter 4. 8.3 million paid net additional subscribers just in the past 3 months. Even in a world of uncertainty and increasing competition, we're optimistic about our long-term growth prospects as streaming supplants linear entertainment, that is to say, entertainment that is delivered through traditional means like over-the-air broadcast or through your cable or satellite TV provider. We're continually improving Netflix so that we can please our members, grow our share of leisure time, and lead in this transition. Our summary of results and forecasts are below. Now, just to break it down right here, I am not going to go through this whole thing because it is a lot of information, and of course, more than we can cover in a reasonably length video. So I want to try to keep this short. I don't want to go on for 2 hours going through this. But as you can see here, quarter 4 of 2020, revenue $6.6 billion. Quarter 4 of 2021, $7.7 billion. That's a heck of a little rate of growth there for total revenue for any company. You like slow, steady-paced growth. I realize that 2020 was a banner year for all streaming services for obvious reasons, but that hyperinflated growth rate that was almost artificially driven, we could say, by people having to stay at home and having nothing else to do. Well, everybody kind of knew that that wasn't going to sustain year to year going forward. So we can see kind of the trends now where that growth is slowing down, but it's not dead. It's still growing. It's just not growing at a pace that some people, I guess, were expecting. Now, again, not to belabor this chart very much, I just want to show a trend because this is very, much of a indicator of where you might see the price of a company like Netflix move in the following days after a quarterly report. You can see here the forecast numbers are in gray, this is what the analysts expected for Netflix to add in terms of new subscribers. And then the green or red dots are what actually happened, or the actuals in this case. If you see a red dot, it means that they performed below analyst expectations. If you see a green dot, that means they exceeded analyst expectations when they released their public data for that quarter. And as you can see here, all through 2020, expectation in the first quarter, 7 million, but they added almost 16. Of course, that's when the coup started and the lockdowns began. Second quarter, same thing, expectations of 7.5, actual at 10.1. Quarter 3, this is when things started slowing down dramatically. 2.5 million expected with a 2.2 million actual. And then in the fourth quarter, a rebound, 6 million expected with an 8.5 million actual. Quarter 1 of 2021. So this is beginning last year. Expectations of 6, actuals at 4. But then quarters 2 and 3 both exceeded expectations. But look at the fourth quarter. Look at the one that just reported there on the end. Quarter 4 of 2021. Okay, we're looking at that right there at the end. I'm sorry I can't highlight just that small portion. But let's look at that last section right there. An expectation of 8.5 million, but an actual of 8.3. They're almost right on top of one another. So it's not as if Netflix dramatically underperformed expectations. They missed the mark by a couple of 2 or 3%. Seemingly not a big deal, but apparently a lot of market folks didn't think so. So let's talk about actual numbers, though. Is Netflix really growing? Are they becoming more profitable? Are movies like Red Notice and things like this, are shows like Cobra Kai, Squid Game, so on and so forth, are these shows really hanging on to the bulk of their subs? Well, the answer seems to be yes. You can look down here. This is just a graphical representation of the chart we just discussed. But look at 2021. It kind of meandered along in almost a nice straight line, and then boom, as we got to the end of the year, a huge spike. Look at the spike in December. Look at the spike in December. Weekly global paid net additions year to date. Look at that spike in December. Gee, I wonder what that had to do with. Might it have been shows like Cobra Kai? Probably so. Netflix knows what's making them money. They know what's keeping subscribers engaged. We had a video earlier this year where Netflix, as a matter of fact, leaked some internal financial data where they disclosed that they had placed a $900 million value on Squid Game, a show that was a huge global hit that cost Netflix somewhere around $20 to $25 million to produce in Korea. It was a magnificent show, an excellent story. The character development was amazing. It was a gripping show. I've watched it twice. I still have to go back and watch Cobra Kai a second time because they're putting out good content that people want, and you can see subscriber growth go right along with it. But more importantly, revenue. By the way, just look at some of the list of films and television shows that they have produced that have topped the Google search charts all year long. TV shows like Squid Game, Bridgerton, Cobra Kai, Sweet Tooth, Lupin, Ginny and Georgia. Now, most of those I've really never heard of, and maybe you haven't either, but a lot of people have. 6 of the top 10 television shows in Google searches all year long were Netflix shows, and Cobra Kai came out at the very end of the year. It didn't even have but a couple of days to really hit that metric, and it did it. It made it all the way up to number 4. Look at the movies. Red Notice and Army of the Dead, pretty good for feature-length films because most people are still searching for movies that are going into theaters. Those are the movies that have the highest rates of advertising expenditure, which we've talked about here before. What did we talk about in a few videos ago when Disney decided to pull yet another Pixar film, Turning Red, from the theaters? I told you that Disney simply made the decision that they did not want to have to commit an additional $100 or so million to global P&A, prints and advertising, or global marketing as it's more commonly referred to put Turning Red into theaters. Streaming services like Netflix or even Disney Plus do most of their spending on trying to entice new subs through broad advertising. Sure, some of that may include some specific show or film, but in general, they're going for a broad-scoped marketing design here. Whereas if you're going to spend $100 million just to get one film into a theater, that's a whole different animal. Netflix doesn't have that. Now, let's get to the nitty-gritty, the final part of this video, because this is where things matter to me. This is where I want to see some improvement over time. And sure, you might have a quarter or two in there for any company that may not perform up to expectations, or they might have some outside force or outside influences that causes growth to not be as good as one would hope, or even maybe a loss in a quarter. But look at Netflix. This is broken down by region, and this is one of the things I love about Netflix because they really tear down into different global regions to give us a good, clean picture of exactly where their subscribers and their revenue is coming from. On the top, we have UCAN, that's the US and Canada, traditional North American markets. So like when we talk about a film's domestic release, for example, Spider-Man No Way Home has crossed the 700 million mark domestically. We're talking about the US and Canada. Here with Netflix, it's the same thing. Look at the revenues, $2.9 billion, $2.98 billion in Q4 of 2020, a little over a year ago now. Up to 3.1, then to 3.2 in Q2 of 21, 3.258, a little bit higher in Q3, and Q4, 3.3. So that's a pretty darn good growth rate. That's a little over 10% over the course of the year. Paid memberships have gone from 73.94 million in North America, US and Canada, to 75.2 million at the end of Q4 2021. That's a good steady little growth, especially for a company that already has had a tremendous amount of market saturation in the US and Canada for years. Remember, Netflix is the biggest, oldest kid on the block. They're the king of streaming. They still are. Compared to HBO Max and Disney Plus, they have on order of almost double the number of subscribers in the US and Canada that those two companies do. In fact, if you put HBO Max and Disney Plus together in terms of North American subscribers, you might just beat Netflix out by a few percent. Now, the next one on the list, the EMEA, that's the European, Middle East, and African markets, okay? They kind of lump all of those together. Revenue of $2.1 billion Q4 of 2020, which has grown all the way up to $2.523 billion a year later in this most recently reported quarter. Good growth rate. Look at the paid memberships, 66 million all the way up to 74 million. That's an excellent rate of growth in that type of market over the course of a year. Latin America, the next one, Latin and South America, I should be more specific. Look at the paid memberships, 37 million all the way up to, or 37 and a half, now almost at 40 million. And then the last one is the Asia Pacific Rim. We have paid memberships starting out at 25.49, now all the way up to 32.63 million. Again, very good growth. And of course, India, one of the biggest markets in that, is included in that regional section. Now, one of the things that Netflix has discussed is they understand that, India, just like Disney does, they need volume, right? You need a lot of subscribers in India to make India profitable because they're simply not able to charge anywhere near as high a rates for paid television as they can in most other more developed areas of the world. Think about Disney Plus that we talk about each quarter when their numbers come out. We always talk about average revenue per user. Let's look at average revenue per user. In the US, average revenue per user or average revenue per membership, as they discuss here, has gone up in North America from $13.51, so $13.51, all the way up to $14.78 at the end of 21. That's an increase of almost 10%. The European market, the European, Asia, and African market here, we're looking at a change of $11.05 up to $11.64. Now remember, once you get outside the domestic market, you have other pressures that can affect that net revenue, and that is currency exchange rates. Latin America and South America, average revenue per user, $7.12 or $7.12, all the way up to $8.14. That's a tremendous rate of growth in a year. And then finally, the Asia Pacific area, $9.32. It had gone up to $9.74 and has come back down to $9.26. What does that tell you? Well, just like with Disney Plus, the more volume that you have in India, the more that ARPU is going to come down because of the lower rates that they charge there. They need more and more volume. Even though their annual or their average revenue per user may be lower, if you get enough of them, you reach profitability, and that's what they're all after. Now, all this being said, this looks like great news to me. Yeah, they might have missed the mark a little bit. Yeah, they might not have added quite as many subscribers as the analysts projected, but they weren't off by much. Like I said, not more than a couple of percent. So does that really mean that the stock is terrible and Netflix is doomed and all this? Well, I personally don't think so, but that's for you to decide. I'd love to hear your comments and your feedback on this. So leave a comment before you head out today. And again, please make sure you hit that like button, that subscribe button, hit that notification bell, and do share this sucker out on the social medias and leave a comment, like I said, before you check out. And until next time, take care.